Hey everyone, welcome back to Corporate Decoder. Today we're diving into Cornerstone Building Brand's latest financial report. It's like peeking behind the curtain of a company that literally helps build America. And spoiler alert, it's not always as solid as the buildings they help create. This report is called an 8K, which is like a financial flash report telling investors about important events. This one's dated April 10, 2025, and it's all about their estimated financial results for the first 3 months of 2025. Keep in mind, these are preliminary, meaning they aren't set in stone yet. Basically, Cornerstone is giving investors a sneak peek at how they think they performed. They are being upfront with potential investors here by laying it all out. They even caution that these numbers could change when they finalize everything. Let's jump into the numbers, which is what everyone really cares about. This table gives us a side-by-side comparison of their estimated performance for the first quarter of 2025 and the actual results from the same period last year, 2024. It's like comparing where they thought they'd be versus where they actually were and how that stacks up against last year. First up, net sales. They're estimating between about $1.16 billion and 1.19 billion Niners for the first quarter of 2024. Then we look back at the first quarter of 2024, they did around $1.15 billion increase. Now let's talk about adjusted EBITDA. This is a key metric because it gives a sense of the company's profitability before things like interest, taxes, depreciation, and other adjustments. They are estimating between roughly $89 million and $95 million for the first quarter. The previous year, they made about $107 million. That's a drop, and we need to understand why. They also show pro forma adjusted EBITDA, which pretends they own two companies, Harvey and Muller, from the beginning of last year for comparison purposes. This gives a clearer view of how their current business is performing relative to how it would have looked if those acquisitions were already part of the picture. This pro forma number is around $133 million the previous year, making the current estimates look even less exciting. They make an important note here saying that these pro forma numbers treat the acquisitions of Harvey Building Products and Muller Supply Company as if they happened at the start of 2024. This is their way of giving a more apples to apples comparison despite the company changing shape. Adjusted EBITDA, as they define it, excludes things like restructuring costs, acquisition expenses, and some compensation plans. Basically, they're trying to show the core operating profitability of the business. Another note explains that the 2024 numbers should be compared with their previous filings from that time, which is standard practice. Here's a potential problem. They estimate that tariffs could negatively impact their adjusted EBITDA by $30 million for the year. That's a big chunk of potential profit that could disappear because of import taxes. This is a big deal, and it shows how global trade issues can directly hit a company's bottom line. However, they also have some good news. They say sales exceeded expectations due to better pricing in their shelter solutions segment and higher sales volumes across the board. Their profits also beat expectations because they managed to keep prices ahead of inflation and improve manufacturing productivity. Time for the legal disclaimer. This is where they remind everyone that these are just estimates and that the future is uncertain. They list a bunch of risks that could make their actual results different from what they're predicting. It's a standard part of these reports, but it's important to remember that anything could happen. They list a ton of things that could go wrong: economic downturns, high interest rates, raw material shortages, inflation, bad weather, difficulty getting financing, and more. Basically, they're saying that the world is a complicated place and lots of things could impact their business. They explain that adjusted EBITDA is a non-GAAP measure. This means it's not a standard accounting calculation. They use it to give investors a clearer picture of their underlying business performance by excluding certain items. Now, they provide a reconciliation table to show how they get from their standard accounting measure, operating income, to adjusted EBITDA. This is important because it allows investors to see exactly what adjustments they're making and why. Here's that reconciliation table. It starts with net sales, then shows the impact of acquisitions and divestitures to get to pro forma net sales. This is how they create that apples to apples comparison we talked about earlier. You'll notice they show adjusted EBITDA as a percentage of net sales. This is a good way to see how profitable they are for every dollar of sales. The previous year was 93%, and currently they sit in the 7-8% range. A significant drop. They add back depreciation and amortization, which are accounting expenses that don't involve actual cash outlays. They also add back things like acquisition costs and facility closure charges. The largest item is depreciation and amortization at over $100 million. They provide an additional breakdown for the impact of acquisitions and divestitures on adjusted EBITDA to get to pro forma adjusted EBITDA. Again, this is all about making the numbers comparable. The report is signed by Jeffrey S. Lee, the Executive Vice President and Chief Financial Officer. Tick now, what does all this mean? Cornerstone Building Brands is facing some headwinds. While sales are up slightly, their profitability is down and they're facing a significant threat from tariffs. They do seem to be managing costs and prices effectively, but they're operating in a tough environment. On the plus side, they seem to be integrating their acquisitions well and they're taking steps to mitigate the impact of tariffs. However, the risks are real and investors should be aware of them. The company is in a cyclical industry, so their performance is closely tied to the overall economy, especially the housing market. If interest rates stay high or the economy slows down, they could face further challenges. Their growth might be capped if they can't find ways to grow revenues while keeping costs in check. Corporate decoder videos.